Ladies and gentlemen, good day and welcome to the Anupam Rasayan India Limited Q1FY22 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Diwakar Pingle from Christensen Advisory. Thank you, and over to you, sir.
Thank you, Janice. Welcome, everyone, and thank you for joining this Q1 FY22 earnings call of Anupam Rasayan India Limited. The results and investor presentation have been emailed to you and also available in the stock exchanges. In case anyone does not have a copy of the same, please do write to us and we'll be happy to send the same over to you. To take us through the results of this quarter and answer your questions, we have with us Dr. Kiran Patel, Chairman and Non-Executive Director, Mr. Anand Desai, Managing Director, and Mr. Afzal Malkani, the Chief Financial Officer. We will be starting the call with a brief overview of the quarter gone by from Dr. Kiran Patel and Mr. Anand Desai, followed by the financial performance, which will be given by Mr. Afzal Malkani. We will then open it over to the Q&A session. I would like to remind you that everything said in this call reflecting any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with the risks and uncertainties that we face. These uncertainties and risks are included but not limited to what we mentioned in the prospectus filed with SEBI and the annual reports, which you will find on our website. With that said, I'll now hand over the call to Dr. Kiran Patel. Over to you, Doctor.
Thank you. A very good evening to our investors in India and a good morning to all of our investors in USA and Europe. I am joined by our Managing Director, Mr. Anand Desai, and our Chief Financial Officer, Mr. Afzal Malkani. I welcome you all to our Q1 FY22 earnings call. The second wave of the coronavirus pandemic had been harsher and has affected many of us in recent months. Thankfully, many states have seen a dramatic improvement and life is starting to get back to normal. Although the fear of a third wave is looming, already some states are starting to see an upward trend. I hope and pray that you and your loved ones are safe and well. The leadership at Anupam is committed and have taken all possible steps at our manufacturing site and corporate office. We are glad to inform you that we have successfully vaccinated 1,250 of our employees, which translates to over 75% of the workforce. We have also extended support to the families of our employees facing COVID-related challenges. Despite the global pandemic, at Anupam, we are transforming ourselves into a fully sustainable business in every way. While the macroeconomic environment is putting our strategy to the test, we continue to grow faster than the industry growth rate. Anupam exhibits the professionalism of a major chemical company while offering the agility and accessibility of a specialized niche supplier to its client. We continue to focus on our custom synthesis and manufacturing business by developing an in-house innovative process for the new chemistries, along with focusing on value engineering by replacing the lower value products with higher value ones. Every year, we also continue to add new chemistries to our portfolio as well as work on future chemistries like ethylene oxide, off-band rearrangements, cyclopropane, chlorination using POC13 and PC15, butyl lithium, and isobutylene. This will further strengthen our multi-step synthesis capability. We intend to capitalize on the industry's potential for a double-digit growth through organic and inorganic means. We have started installing a solar power plant. We will continue to increase utilization of solar and wind power, ensuring environmental safety and increasing profitability. These strategies act as a compass to keep us in track even in the face of adversity. We have delivered an excellent quarter on multiple fronts in the terms of both revenue and profitability, be it quarterly or year-over-year growth. For the quarter ended Q1FY22, we reported consolidated total income of Indian rupees 238 crores compared to Indian rupees 135 crores in the same period last year, a year-over-year growth of 77%. Consolidated EBITDA during the quarter grew by 101%. It went from 32.25 crores to Indian rupees 65 crores. EBITDA margin increased from 24% in Q1 2021 to 27.28% in Q1 2022. We continue to build our business with our focus on the core values of quality, innovation, environmental sustainability, human and social responsibility. Anupam's dedication to a sustainable future has spanned more than 3 decades. We will continue to make a determined effort to fulfill our environmental, social, and governance responsibilities and report our progress transparently to all our stakeholders. This has concluded my remarks, and I will hand over to Mr. Anand Desai, Managing Director. Mr. Anand Desai.
Yeah, thank you, Dr. Patel. Good afternoon to everyone. To begin, I wish you and your family members are safe during these unprecedented times. Further, I'm delighted to meet everyone again after what I believe was a very good quarter for our company, and to discuss further the development and results of the quarter gone by. We are committed to our employees' health and well-being, so we are always putting our efforts into building the greatest possible work environment that is safe, diverse, impartial, welcoming, and value-driven. We have learned a lot about dealing with COVID in the last year, and vaccination is the most effective solution. As mentioned by Dr. K, we at Anupam continue to strictly follow the national and local guidelines and continue to monitor the situation regularly and take any steps required accordingly. We have maintained a prudent and disciplined approach over the years, which has served us well in these difficult conditions. In Q1 FY22, our cost containment measures and operations contributed to savings reflected in our bottom line, with our profit after tax at rupees 32 crores in absolute terms, and a profit after tax margin of 14%, which is an increase of 500 basis points for the last quarter of Q4, that is Q4 FY21. This expansion in tax margin was led by the aggressive deleveraging undertaken by the company post-listing. Our strong financial position enables us to pursue and commitments of growth to our stakeholders. We are progressing in line with our guidance plan. At the macro level, the current pandemic has re-emphasized the critical nature of specialty chemicals, providing abundant growth opportunities for us. As we know, China Plus One strategy continues to realign the global chemical sector and continues to be a tailwind for the Indian chemical industry. Our key goal is to remain focused on specialized niche molecules and continue expanding our product portfolio with the help of our strong R&D team and technical capabilities. Our continued value re-engineering efforts do provide us and our clients with high quality products which contribute to our revenue expansion in this quarter. The focused execution of our strategy, fueled by our strong capability and track record of commercially manufacturing products, deploying continuous process technology, improving macroeconomic factors and industry sentiment, position us as the preferred partner of choice for our key clients, seeking a long-term and reliable partner. This enables us to increase our wallet share with existing clients and grow our market share while maintaining competitive pricing. We are continuously working on various molecules in both life sciences and other specialty chemicals in our R&D. As you would know, we have repaid our outstanding debt of ₹563 crores as promised to our shareholders earlier, and which was reiterated in our last call. This debt reduction is a major accomplishment for Anupam. We will continue to concentrate on optimizing and enhancing our efforts to create long-term value for all our stakeholders in the coming decade. Now I will hand it over to Mr. Afzal Malkani, our Chief Financial Officer, for a financial overview. Afzal?
Yeah, thank you, Anand bhai. Good afternoon, everyone. Now I would like to briefly touch upon the key performance highlights for the quarter ended June 21. For the quarter ended Q1/22, we reported consolidated total income of 238 crores compared to 135 crores in the same period last year, a YOY growth of 77%. Our profit after tax stood at rupees 32.10 crores. Our interest cost has reduced from rupees 17.88 crores in Q1FY20 to rupees 6.6 crores in Q1FY22. Moving on to the segment-wise performance for the quarter ended Q1FY22, our life science segment contributed 205 crores compared to 122 crores in Q1FY21, registering a growth of 68%. While other specialty chemicals, which also grew by 123%, contributed INR 29 crores compared to INR 13 crores during the same period last year. In percentage terms, life science segment contributed 88% of the total revenue and 12% from other specialty chemicals. We can say that all our segments have grown equally, whether it is crop protection, personal care, pharma, pigments, and polymer additives. In Q1/22, 75% revenue growth came from the recently commercialized units and products, and 25% growth came from our conventional products. This growth was primarily driven by better capacity utilization of newly commercialized unit 5 and 6. Both of these units were commercialized in March 2020. In Q1FY22, the capacity utilization for both these units was around 70%. As far as revenue breakup in terms of geography is concerned, in Q1FY22, the contribution of India was 50%, Europe 23%, Japan 10%, Singapore 10%, China 5%, and remaining 2% from the rest of the world. For the whole year FY22, we expect that the proportion of export sales will be 60% and domestic 40%. So in FY22, the maximum growth will come from the export market. We commercialized a new molecules in Q1FY22, and we are planning to commercialize about 10 new molecules in the current financial year, which will contribute significantly in the growth in FY22. Our top 10 customers contributed about 84% of the total revenue. However, there are total 24 products in this. For most of the products, as you know, we are either a sole supplier or one of the two suppliers of the product for this customer. We have incurred a capital expenditure of about rupees 10 crores in Q1FY22. Let us close our opening remarks, and now the floor is open for question and answer.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on a decent set of numbers. So my first question on the gross margin front, if you can help us understand, the improvement that we have seen, whether it was largely driven by the product mix there, or we have been able to pass through the price hike, the raw material inflationary trend to the consumers.
Yeah, we can say if we talk about the growth in terms of margin, then we can say that it is due to the favorable product mix during the Q1FY22. And if we talk about the volume and price growth, then we can say that out of 73% growth, 63% is the volume growth and 10% is price growth.
Sure. And sir, just a follow-up on that, if I compare our gross margins on a quarter-on-quarter basis, there has been a decent jump. Last quarter, I do recollect, the pressure on my margins front because of the pricing trends as well, raw material inflation there. So if you can share some color, where we are in terms of renegotiating the prices with the customers given the raw material inflation. And whether, it will be right to look at from a Q1Q comparison perspective or there will be a seasonality angle.
Yes, if we see if we talk about the margin, then I would say that you can consider a sustainable gross margin as in the range of 57 to 59%. And EBITDA margin, you can consider 24 to 27% as a range. And if we talk about the raw material price, then particularly your question is about the customers, what is the status of that? For that, I would like to say that though the formal discussion with the customers will happen in the month of December when we negotiate the next contract with them. So by that time, you can consider that this margin as a sustainable during at least the second quarter also.
Sure. Sir, where I was coming from was more from a working capital perspective as well, and the related raw material pass-through. Because earlier we were going ahead with the 12-month pricing, but as per our earlier discussion, you mentioned that incrementally we will be negotiating more on a 6-monthly or slightly lower, in terms of overall working capital trend and the pricing pass-through there. So where are we in terms of those negotiations with the clients?
Yeah, for that, as I mentioned, that we are going to renegotiate the terms and conditions from the December 2021 onwards. As you know, we finalize the price in every December. So at least for the September or next December, this will continue. And from March 22 onwards, you can see improvement in working capital cycle. And our discussion is that the formal discussion will start, but we have already informal discussion has been initiated with the customers and we got the positive feedback on that.
Sure, sir. That's helpful. That's it from my side and all the best. Thank you.
Thank you. The next question is from the line of Faisal Hawa from HG Hawa & Company. Please go ahead.
Yeah. So, sir, what is the total number of customers that we have as a grand total of in all the verticals? And how many customers do we have in export and in local market? That is one question. Secondly, if we have to give one, core DNA to our company, then what is that DNA through which the entire business strategy runs?
Yeah. First, if we talk about the number of customers, then total number of customers is 66, out of which export customer you can consider about 20 and remaining 46 within domestic customers. And if we talk about the first the core expertise or what is the DNA of the Anupam, then we can say that our expertise is in chemistry. And the key differentiator for the Anupam is that we have the ability to innovate technologically. because we develop our own manufacturing process, and even when the process is given by customers, then also we do innovation in the process. And when we talk about the innovation, then we talk about two types of innovation. One is the innovation in process, and second is innovation in operations. In operations, you can consider by changing the equipment and all these things. Because the customer point of view, most important thing is that you should be agile, and you should have a flexibility to adapt the changes. And you know that we have a multi-purpose plant, and we can manufacture the products in the same manufacturing facilities. So that's the reason why we have the ability to innovate, and we are the preferred partners for our customers. Second, we have a wide range of complex chemistries, and all the chemistry developed in-house. And we have a capability to perform all the multi-step synthesis products, say 15 to 17 steps, because we have 6 manufacturing facilities. We have facilities for a multi-purpose chlorination, multi-purpose nitration, as well as multi-purpose derivatization and hydrolysis plant. This you can understand in a way that the customer who is looking to outsource the product, which requires 15 to 17 steps, would prefer to deal with the partners who can manufacture the entire product in-house. And if they outsource it to those who can do only 5 to 7 steps, then the management of entire supply chain would become very tedious and time-consuming for them. So we are in a better position to become a preferred partner for such customers. And if we can third, that our ability to manufacture the products in a continuous process. And I would like to say that the manufacturing the products in a continuous process in a commodity is quite simple, but the manufacturing the product in continuous process is in a specialty chemicals is quite difficult. And fourth is our ability to manage our product portfolio and to convert the waste into byproducts. This 3 to 4 considered as our key expertise.
So, sir, what is our R&D spend per year? And secondly, sir, what would be the contribution of new products to our revenue in the which have been introduced in the last 4 years, and what would be the contribution to revenue in this year for those new products?
Yeah, your first question about the R&D. For the R&D, our R&D expenditure will be 2% of the total revenue. And if we talk about the capital expenditure, then in last 2 years we have incurred a capital expenditure of rupees 30 crore rupees for setting up of a new R&D and pilot facilities. Your second question is about what is the contribution from the new products. Then I would say that in the current year, if we take the current year as for the calculation purpose, then in the current year, out of the total revenue, 20% revenue is coming from the new product, which is the new commercialized during the current year, and about 30% revenue coming from the recently commercialized products.
Thank you very much, sir. That answers all my questions.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Madhav Mehta from Fidelity International. Please go ahead.
Yeah, hi sir, good afternoon. Thank you so much for your time. I just wanted to get a sense from you on the order pipeline. We did announce some good contract wins a couple of months back. Are there any more such discussions that are ongoing with our customers for further such long-term contracts in the pipeline? If you could just give us some sense around that.
Yeah, Anand, I would like to address this.
No, Abdullah, you go ahead.
Okay, fine. Okay, so yeah, Madhavji, if we talk about the total product in pipeline, then as I mentioned that we are going to commercialize 10 products in the current financial year. And in addition to that, we have more than 70 products in a pipeline for our existing customers as well as from the new customers. And we have been discussing with the existing customers since last 2 years, because for any new product, the commercial from the initiative, from the inquiry to commercialization of the product, it will take 18 to 24 months. So you can see some new product commercialization in coming quarters.
Yeah. No, my question was, in May and June, we had announced some contracts which were like 3-year contracts or 5-year contracts with customers. Are there any more such contracts in the pipeline which can be like large contract wins which span for like 3-5 year time frame?
Yes, we have been discussing with our customers, but we have a constraint in our capacity also, because as you know that our unit number 5 and unit number 6, we are going to commercialize, we are utilize about 75% in the current financial year, and the utilization for all this unit 5 and 6 is about 90, will be about 90% in the next financial year. So we don't have a capacity for to accept this new order for new products. So we have been discussing and exploring the option of bottlenecking, debottlenecking, or value engineering by replacing high value products and replacing the low value products with a high value product. And if we materialize this, then we will announce in the next quarter.
Okay. So maybe my question would be that given that next fiscal we expect to reach very healthy utilization, is there any more capex program which is on the drawing board for us already, which we might announce and then sort of start working on from next year onwards, given that we are reaching a good utilization?
Yeah, first, as we have given an indication about the capex for this LY which we received in the month of May and April for this 1100 crores as well as 540 crores, for which we need a capex of about 60 to 70 crore rupees, which we will start from the next quarter onwards.
And what would be a full total capex requirement for FY22? And
for that, apart from this 70 crores, apart from this 70 crores, we have been working on the new capex requirement. But going forward, we are planning to go for the modular capex. So it will be in the tranches of 50 to 60 crore rupees, not like that 300 or 400 crores, but it is in a small tranches. We are going for as a modular capex for that.
And the asset turn would be better, right, on these modular capex, because it's more downstream sort of thing.
Yeah, for all the new capex, the fixed asset turn will be more than 1.75.
More than 1.75. Okay. And my other question was, are we seeing any good inquiry flow for products outside of pharmaceutical and agrochemical, like the other verticals like electronic chemicals or some of the other end markets? Are we seeing good inquiries from those markets as well?
Yeah, Anand, would you like to?
Yeah, I'll take this, Azul, right?
Yes.
So, as we mentioned earlier in the last call, we are working on some new products which will be going in some new applications. These are totally brand new products in India or even Asia for that matter, and they will be going into a telecom application. So there are 3 products, but these are under confidentiality agreement. We are not able to share more data, but in the coming quarters we'll be able to inform you more about once we are able to explain more.
Okay, cool. Understood. Thank you so much.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Rohan Gupta from Edelweiss.
Yeah, hi sir. Good afternoon. Sir, couple of questions. Sir, first is on our margin, EBITDA margin. So, sir, when we were discussing last quarter, you mentioned that definitely some of the contracts will come in a price negotiation by end of the current year, and definitely the raw material prices have been continuously rising. But sir, despite that, we have seen that on quarter, our EBITDA margins have improved to almost 26% in the current quarter versus 23% in Q4. While I understand the raw material prices kept on rising, we could not take the sufficient price increase to pass on that cost. So, under that light, sir, just wanted to understand how the margin improvement has happened, and is it driven by the product mix change and all, and if when we will take the sufficient price increase, then what kind of margins we can reach?
Yeah, if we talk about the EBITDA margin, then yes, we decide the price with our customers in December. But as you know, that we keep our inventory immediately at any given point of time, 6 months inventory in the form of raw material, WIP, as well as finished products. And we have a back-to-back contract with our suppliers for 3 months. So we cover a 9-month inventory against our total requirement. So we have not faced any challenges due to this increase in price or any volatility in the raw material price. So that's why we are able to sustain our margin.
Okay, so you are saying that we definitely have sufficient raw material inventory, so even the prices have been going up, we were not impacted by that.
Yes.
Okay. And sir, when you had mentioned that in the last quarter also, and during the IPO meetings as well, that now your company has become a sizable player, and though initial year the focus was more on winning the contract and on revenue growth, that's where you have to probably compromise on a inventory cycle and higher data days and probably keeping the higher inventories, but the focus will be definitely reducing the working capital, probably bringing it down in line with the industry average. So have you seen that any those things happening in last 3 to 4 months, or as you mentioned that the price negotiation will further happen only in month of December, so are we still living with such a high kind of inventory environment, and that may continue? Just wanted to more clarity on that, sir.
Yeah, first, because this will continue till December, because we had maintained this type of inventory, that's why we are able to maintain the same type of EBITDA and as well as gross margin. So this practice will continue till December, and for the January onwards, you will see some improvement in this, because as I mentioned earlier, that the formal discussion with the customers will start from December 21 only.
So sir, it will be like, all of a sudden we'll enter or we'll negotiate with the contract that now we are not going to have an annual contract, and it will be more on the monthly or shorter term contract, quarterly contract, or we have already started having discussions with the clients and they have started accepting our terms and conditions. So, or we have to wait till December and then understand and hear what customers are having to say.
Yeah, initially we are going to propose 2-tier pricing mechanism instead of annually. We are going to for a 2-tier semi-annually. Not we are going to propose a monthly, which will be difficult for the customers also. Our first stage is to propose 2-tier pricing mechanism, and after that on a quarterly basis. Then
Okay.
if we do this, then also we will be able to curtail our inventory significantly instead of this 1 year to 2-tier pricing mechanism.
Minor. Sir, I have a follow-up question if I am allowed to ask one second question. Sir, this is on, you mentioned that China Plus One strategy globally have ultimately started helping us, and you are seeing the very positive industry environment. So can you elaborate a little bit more in terms of this? So we have been hearing a lot of inquiries have been coming in last 1 year, and many global players looking at China Plus One strategy. Have it started really converting into final orders or final capacities being put up for China Plus One strategy? Because ultimately we have a long gestation project, always more than 18 months to 24 months to going up to even sometimes 3 years as well. So is it still only inquiries you are seeing from the global customers, or there is some kind of final win or final deal or some concrete plans which global players have while they are now discussing with the customers like us?
Yeah, China Plus One strategy has definitely increased our number of inquiries from the customers. So we have not seen a major shift as we are into specialty chemicals and not in the commodity market. Transfer of cost model with our customers. However, we believe that India will become a second major global supplier for international customers within 5 years. And this is basically due to the stringent environmental norms in China. And further other factors, such as particularly if we talk about the Anupam also, then in compared to this China, We have a low labor cost, lower operating cost, now in competitive infrastructure, and as well as the business-friendly policies, particularly PLI scheme type of things, will help us to materialize on China Plus One strategy. And we hope to, however, we hope to get the benefit of this China Plus One strategy over a medium to long term.
Thank you, sir. I'll come back in for follow-up questions.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Sir, my question is on the realization front. Based on the production in this quarter, your average realization was at about 426 rupees a kg, which is lower than 444 rupee a kg you did in FY21. So is there any particular reason for the same?
Yeah, you were talking about this average realization, right? And which you mentioned about 426 rupees.
Correct.
No, if I say then in Q1 FY22, our average sell price of the product increased from rupees 730 per kg in Q1 FY21 to rupees 806. If we talk about for the whole financial year 22, then our average sell price of the product is estimated to be rupees 900 per kg compared to rupees 810 per kg in the financial year 21.
Okay. Sir, but your production for this quarter was 5,492 tons. Is that correct or no? Based on 81% utilization.
No, because we have a multi-purpose plant, so you can't compare this with the dividing by multiplying to total capacity multiplied by percentage.
Okay, fair enough. Thank you. And so just wanted to check. On the domestic contribution side, you had about 50% revenue from the domestic market. So is it going to be likely the same scenario in 2Q, like 1H would be heavy on the domestic side going forward as well?
If we talk about the whole financial year FY22, then current it is 50-50 between domestic and export. But for the whole financial year FY22, it will be export will be 60% and domestic will be 40%.
Okay, so and is in FY23 is it going to be the same?
Yes.
40?
Yes, maybe export proportion may increase from 60 to 65%. But yes, minimum 60% we will maintain.
Okay. Thank you, sir. That's it from my side.
Thank you. Reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. A reminder to all participants present in this conference, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Bharat Gupta from Edelweiss Securities. Please go ahead.
Hi, sir. This is Bharat from Edelweiss. Couple of questions, sir. First is in regard to the 10 new products which we are about to launch in FY22. Can you give us a sense about the growth potential and in what particular segments they would be utilized? The end user industries are likely to be same, like agrochemicals, 80% contribution, or there can be a difference where the contribution may increase for the other specialty segments?
Yeah, if we talk about the segment-wise of these 10 molecules, then we can say that it is in the same proportion. You can consider 70% from the crop protection and 10% from the pharma and remaining 20% from the other segments. And if we talk about the future revenue, then as I already indicated that in the current year, this proportion will be 20% of the total revenue. And next year, it will further increase to at least 35 to 40% for this top 10 products. This 10 commercialized new products.
Right, sir. And sir, my last question pertains to the capacity. Like we will be having a capacity constraint as we go ahead in FY23. So beyond FY23, do we have a capex plan in place where we can continue on a similar growth trajectory? Like, is there a vision and what kind of a capex requirement we would be needing in order to sustain the growth momentum? Like we have been doing a 34% kind of a growth, which we have even highlighted so far. So what kind of a capex involvement would be there in order to sustain it?
Yeah, we don't need to go for the capex to take care of the growth till FY23. But to continue the same type of growth trajectory from FY23-24 onwards, we may need to go for the capex. For that, one is about the 60 to 70%, 70 crore rupees capex, which I spoke, which was in connection with this LY we have received. And apart from this, we are also planning for some other capex, but we have been working on that, and we will be able to announce in the next quarter on that. But this will be modular capex. This will be a significant capex.
And sir, in order to continue our growth journey, so are we looking at or are we eyeing at the opportunity in terms of the off-patented molecules, which will be losing out the patent status in FY23? Like, have we also that particular thing in mind? Like, we have already done a significant amount of investment in R&D side of it.
Yeah, if we talk about this. Hello.
Hello.
Yes, sir, you may go ahead.
Hello. Yeah. Hello. Hello. Yes. Please. Can you repeat question? Hello. Hello.
Yeah, sir. Hello.
Yeah.
Am I audible?
Yeah, please, can you? Yeah. You are audible. Yeah.
Yes, sir. So I was just saying, like, in terms of meeting out the target, in terms of a target growth. So first, what kind of a growth levers should be there in place? Like, and secondly, hello.
Yeah. Go ahead. Yeah. Go ahead. Yeah.
Sir, we've just lost the line for the current participant. We would proceed to the next question from the line of Ankur Periwar from Axis Capital. Please go ahead.
Yeah, hi, sir. Sir, just two follow-up questions. So one, if I refer our this quarter presentation, we are mentioning, the MNC customers at around 22 odd numbers, which was slightly higher than the last quarter number. So this quarter we are around 23 MNC customers, as you mentioned, and last quarter this number was, lesser. While the total number of clients is largely similar, so 64 to 66. So is there some churn in the customers there?
Yeah, I think 5 export customers have been added, and the 2-3 domestic customers were reduced.
Okay, and sir, any specific reason for the exit of the customers?
So this export customers, we have started a new relationship, but the volume is on lower side. And for the domestic customer, we have a multiple customers for maybe the customer maybe for the 3 crore rupees or 5 crore, particularly in pharma. The customer to customer, the volume may be 1 crore or 10 crores. So it may increase or decrease by quarter.
Okay, fair enough. And another thing on the asset turn side, you mentioned, the incremental capex will be garnering an asset turn of around 1.7. So, on an aggregate basis, let's say as a portfolio, as an aggregate gross block, what sort of asset turns are we targeting, let's say 2-3 years out on full utilization?
Yeah, the last year our turn was about 77, and the current year it will further improve to 1.04. Next year, we are expecting to further improve to 1.3 to 1.35. And after 2 years, we are expecting to improve to 1.5.
Okay, fair enough, sir. That's helpful. Thank you.
Thank you. We take the next question from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi, sir. Thank you very much, sir, for the follow-up. So you mentioned on this incremental CapEx and asset turn of 1.7x. So, so can you give some indicative numbers that what kind of incremental CapEx we can put over next 2 to 3 years cumulative, on which we will enjoy this benefit of 1.7x asset turnover, and after that we have to further to start putting the basic CapEx and infrastructure led CapEx, which will further reduce our asset turn to maybe 1.2 to 1.5%.
Yes, if we talk about the capex, then first, as I spoke, we are planning for 70 crore rupees capex for which to execute the LOI. Okay, and apart from this, we are going for the modular capex. We have 5 to 6 projects from 5 to 6 different customers, and the project size is 50 crore rupees per project per customer. And this type of 5 to 7 projects is in pipeline. So we will do capital rationing and we'll select out of this 5 to 6 projects, we may select 2 or 4 projects based on the convenience. But this we will decide on next quarter. Because as I mentioned that we are
currently you mentioned 70 crore, right?
Yes, 70 crores.
And out of that, you have 6 to 7 projects right now, each 50 crore capex opportunity, but you will choose 4 out of them.
Yeah, we may select 2 projects or 4 projects because now we are going for modular capex only. So we have a choice to select.
Sir, can you just give a little bit more on this 5 to 6 different projects which you have, each offering 50 crore opportunity? How you have got this customer, what they have given you in offer, what are your terms, and why you will be only selecting 4 out of them and why not all 6 or 7 out of them?
Okay, because as the basic our benchmark is to have that we need a minimum 20% EBITDA for any project. This is the first benchmark. And the second is that we, as I mentioned, that we have been working in our R&D and pilot facilities in more than 70 products. So out of these 5 to 6 projects, we have been working on this project since last 2 years. And this we are now anticipating, we are expecting to materialize in next quarter. So on the basis of this R&D trial has been completed, pilot facilities has been completed, and we have already, for the couple of products, we already took the trial run in our existing manufacturing facilities also. And out of this 5 to 6 projects, our 70 to 80% project is with the existing customer also. So that's why we are saying that we have a choice for selection out of this 5 to 6 projects.
So, sir, you mentioned that 20% benchmark is a minimum criteria for in terms of EBITDA margins for selection or finalization of any project, right?
Yes.
Okay, so may not that all the 5, 7 projects which you are doing are offering the same margin profile. Is it so?
This I am saying that this is at least the first year, at least a minimum 20%. So we have been working on that project, and on the basis of that, we will be able to finalize by the next quarter.
Right. But sir, definitely on all these 5 to 7 projects, we have been working from almost last 2 years, and these are all our existing set of customers.
70% existing. 70% existing.
70% are existing, right? So sir, I was just a bit curious about to know that how these customers behave, and I mean, is it only they are so sticky about the margin product? Our 2 years of work, we had to just let it go because they are not they are not able to raise the margin, or there are some technical glitches. Because of that, we lose on the customer, we lose on the contract, because there seems to be pretty good contract of 50 crore each, probably with a long-term revenue potential with the existing set of customers. So I was just curious to know that when and in what condition we lose a project only because of margin, the customer is not able to match our criteria, or there are some other reasons as well, that sometimes the chemistries or any other reason that also plays when we let go any of such projects.
Yeah, for the technical side, we don't see any challenges in this because as I mentioned that this has been approved in the R&D as well as the pilot facilities, and couple of products we already took the plant trials also from our existing manufacturing facilities also. But for this to give the capacity commitment, we need to do the capex. So we want to do the capital rationing in this project. So that's why have been working on that project, and we will be able to finalize by next quarter.
Okay. So it is more to do with the capacity constraint which we have. Because of that, we have to maybe select not all the projects, but only maybe 2 or 4 projects out of them.
Yes.
If you had enough capacity or if you had enough money in your pocket that you can further invest in the capex, and so that probably then you would have been in position to take all the projects. Is that so?
Yes, definitely. Absolutely correct.
So how many such projects are in pipeline right now? I mean, you mentioned definitely 5 to 7. Out of that, 2 to 4 definitely will be finalized over next maybe 2 to 4 quarters. But definitely these projects have a long gestation, as you rightly mentioned that you have been working on these from last 2 years, right? So how many more such projects apart from these 5 to 6 projects right now you have for next 2 to 3 years pipeline, or which will get converted into revenues for over next 2 to 3 years? How many such projects we are working right now, sir?
Yeah, we have been, as I mentioned, that we have been working on more than 70 products, and we have also increased our R&D and pilot strength in last 6 months. So we want to execute 2-3 new projects in every year. That's our target. Not only for the next year or the current year, but every year we want to do 2 to 3 projects.
Okay, so we have a very solid line of almost 70 such projects we are already working, which are somewhere in the pipeline or somewhere in the funnel, which ultimately we will choose over some period of time, right? And only constraint is a capital according to you. If you have just in a hypothetical scenario, if you have unlimited money or enough cash in your pocket, you would have probably taken most of these projects which you are working right now. Is that understanding right, sir?
Yes, every year we are planning to commercialize about 5 to 7 products. And if we talk about the capital expenditure, that not necessarily for all the projects we may need capital expenditure. Few projects we can do from our existing manufacturing facilities. As you know, we have all the manufacturing facilities are multi-purpose in nature, and we have an option of value engineering by replacing low value products with high value products. That's also we can explore whenever possible.
Sir, once again, because of the curiosity, sir, 6 to 7 projects which you have right now, you will only select 3 or 4 out of them, but they have been engaged with you. The customer have been engaged with you with almost last 2 years. What will happen to the another 3 to 4 which you will not select? What options they will have? Are they simultaneously working with other manufacturers, or if not, then how their demand is going to be met, sir?
Yeah, so our customer, if we talk about the customer point of view, then in a specialty chemical, generally our customer don't select 5 suppliers for a single project. They select 1 or maximum 2. But we have a clarity for that which project we are going to get out of this 6 to 7 projects. And customer is also also know about that which project we are going to do. So we have a clear clarity about that which project we are going to select.
Okay, so customer is also simultaneously working with some other supplier, and they also have somewhere in the back of their mind that they will not be getting this project manufactured by Anupam, but they need to finalize someone else's project, right?
Not 100% right. Not in every project customer have a second supplier. Maybe out of the 7, maybe 1 or 2 projects the customer may have a second supplier.
Fine, sir. We'll have a separate discussion on that for the further clarity on that. Thank you so much, sir. Thanks a lot.
Thank you. We take the next question from the line of Anirudh Naha from PGIM India Mutual Fund. Please go ahead.
Yeah, good afternoon, sir. A couple of questions. One is, what is the present capacity utilization and when do we reach peak capacity utilization on the present set of assets? And secondly is, what will drive your asset turns from probably zero point 0.7 to 1.7 over the next 3-4 years? Is it going to be higher productivity, or is it going to be higher in products that you are going to work on which have better realizations, or is it just the sweating of the present assets?
Yeah, if we talk about the capacity utilization for all these manufacturing facilities, then we have total 6 manufacturing facilities, out of which you can consider capacity utilization for our unit number 1, 2, 3, 4 as 80%. For unit number 5 and 6, average capacity utilization is 70%. In the current year, in FY22, this capacity utilization will be 75% for unit number 5 and 6. And the next year, the capacity utilization will be 90% for this unit number 5 and 6. And in the last year, it is the unit number 5 and unit number 6 was commercialized in March 2020. So FY21 was the first year of commercialization of both these projects, unit number 5 and 6. So that's why our fixed asset turn was improved from 0.56 to 0.77 in FY21. And for this still better capacity utilization, it is further going to improve from 0.77 to 1.04 in the current financial year. And when we will be able to achieve capacity utilization of 90% in next year, then it will further improve to 1.30 to 1.35. And I was talking about the average fixed asset turn of 1.5 in next 2 to 3 years. 1.75, I was talking about the new project.
Okay, that answers my question. Thank you very much.
Thank you. The next question is from the line of Vidit Shah from IIFL Capital. Please go ahead.
Hi, thank you for taking my question. So in your opening remarks, you mentioned about utilizing on industry potential to via organic and inorganic means. So can you, highlight some details on the inorganic means that or inorganic plans of what sort of assets or targets that you would be looking at, and what areas that you would like to add to your existing hospital?
So we have been evaluating potential acquisitions in specialty chemicals, and we'll continue to actively evaluate for the inorganic growth of the company. And currently, we have been considering a couple of potential targets. However, we are very meticulous and selective in this process. And the size of the acquisition you can consider in terms of revenue may vary from 200 crores to 500 crores. And this acquisition should add synergies in terms of both product and customers. It should help us either as a backward integration or forward integration in our existing business. This will not only for the sake of revenue or profitability, but it should add synergies in our existing business.
Okay, but it would be within the same range of chemistries, or it would also add to capabilities as well?
Yeah.
Okay, fine. Understood. And secondly, sir, regarding your debt, is there any other repayment which is due, and would the finance cost, which is roughly around 6.5 crores, in 1Q, would that be coming down any lower in the next few quarters?
Yeah, it will be lower, but not significantly, because till 31st March 21, we repaid our total 470 crores loan. Till 30th June 21, we repaid 530 crores loan. And as of today, we repaid entire debt, which we proposed in the IPO of over 560 crores. We repaid entire debt of 560 crore rupees. So you can see some savings in the finance cost, but not significant.
Okay, fine, sir. Thank you. That's it from me.
Thank you. The next question is from the line of Bharat Gupta from Edelweiss Securities. Please go ahead.
Hi, sir. Apologies, my line got disconnected while asking the last question. So I was asking on the new molecules front, like we have already stated that there are around 60-70 molecules in the pipeline. So just wanted to understand whether these molecules are in linked with the off-patented molecules pertaining to agrochemicals or to API segment. And apparently, like, are we also have a vision like to be in the branded front, like where like from the current generic one to like getting a contract for the branded molecules for the global innovators. So are we thinking on the similar lines going ahead?
Yeah. First, if we talk about the molecules, then you can consider the same proportion for the agro, pharma, and other than this is license specialty chemicals. Means 70% agro, 10%, 10 to 15% pipeline in the pharma, and 15% in the other specialty chemicals. And if we talk about the whether we are looking for the patented or off-patented products, it doesn't make much difference for Anupam whether the product is in patent or off patent, because Anupam, even when the product is off patented, then also we do innovation and optimize the cost, and so that's why it doesn't make much difference for Anupam.
Right, sir. The margin trajectories across both the segments would be on a similar line, or there is a sharp amount of a difference if we go? Because
no.
Generally we keep our margins on a 24 to 27% range, I think.
Yes, similar margin.
Right. My question was pertaining to like, have innovators have approached us in terms of getting novel molecules in place and working on the custom engineering front or the process engineering front on the branded molecules as such?
Yeah, we have a good ideal mix of both in our pipeline.
Right, sir. That's it from my side. Thank you, sir.
Thank you. We take the next question from the line of Manish Gupta from Solidarity Investment. Please go ahead.
So can you share what's your total debt as of 30th June?
Yeah, as on 30th June, total bank debt was about 74 crores, and the unsecured debt from one of the promoter was about 225 crores.
Okay, so your total debt is give or take 300 crores, and out of that, debt from promoter is 225, right?
Yes.
Now, your EBITDA in Q1 was 60 crores, right? So let's say, your EBITDA for the full year would be, if I just annualize that, roughly 240 odd crores, right? It might obviously be a bit higher. My question is that in response to a participant's question, you said that because of financial constraints, you're not taking on new projects, but your debt to EBITDA seems, well under control. So if, we believe that India is sitting on the cusp of this big China plus one opportunity, and there is an opportunity for us to take business and market share, and our debt is well under control, I'm not being able to reconcile these two statements. Clearly, I'm missing something, sir. Can you please help me understand what the disconnect is?
Yeah, sure. First of all, I spoke that out of these 5 to 7 projects, considering the capital rationing, we may select 2 projects, 4 projects, or 5 projects. This is not a case that we are not going to select any project. And if we talk about the capital expenditure, then we would like to inform you that in last 4 years, we did a front-ended capital expenditure of about 900 crores, for which we have a sufficient capacity available to take care of the growth till FY23. So we have been growing at 34% in last 3 years, and we can continue the same growth trajectory till FY23 without incurring any new capex. And to take care of the growth from FY23 onwards, we are already considering a capex of 70 crore rupees, as I mentioned, which we are going to start from next quarter onwards. And for the other than this 70 crore also, I mentioned that we are going to select maybe 3 or 4 projects out of 6 to 7 projects. So if you consider the value, then it will be a significant amount of capex. We are planning for that.
Okay, this is clear, sir. My second and last question is that, if we look at the business on a steady state basis, what is the steady state return on capital employed of the business?
Maybe in the range of 17 to 20% in the range.
Okay. And this is under the assumption of about 1.5 time asset turn, fixed asset turn?
You can consider the range of 1.3 to 1.5.
Okay, fine. Thank you.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments.
Yeah. To summarize the discussion, we expect the economy to recover from the impact of the pandemic in the near future. And the specialty chemical sector is one of the few sectors that will surely do well going forward. And we as a company deliver personalized and customer-centric service because we look at our customers as our partners. The outlook for the coming quarters remains positive for us, and we are confident that we will be able to maintain momentum as we move forward. Finally, we would like to thank our investor community for their support and faith in us. We hope we have been able to answer all your questions adequately. If you have any further questions or would like to know more about the company, we would be happy to be of assistance. Also, you can contact our IR agency, Christensons. Stay safe and stay healthy. Thank you once again for taking time and to join us on this call.
Thank you. On behalf of Anupam Rasayan India Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.